Imagine this, you're in your 60s and you're retired and you're paying no income taxes even though you have $100,000 of income. You might be thinking to yourself, Jacob, that's not possible. Surely I'm going to be paying taxes when I have income, right? Well, normally, yes, but it doesn't have to be that way. In fact, I'm about to show you how you can have $100,000 of income in retirement and pay no income taxes. Hi, my name is Jacob Duke, and as the owner of a retirement planning firm, I know how frustrating it can be to pay income taxes in retirement, especially if there are ways that you can minimize or avoid those taxes. So let's look at Dan and Molly's situation to see what they can do to generate $100,000 of income without paying any taxes. So right here, we've got Dan and Molly, and you can see they're 64 years old. They're both retired. And in terms of their Social Security income, we're just going to use a baseline, kind of a standard of about $50,000 per year combined. So it'd be $25,000 each. And they're already both receiving that. So they took theirs just a little bit early. They have about $600,000 in traditional IRAs. They've got $200,000 in Roth, and they have $200,000 in brokerage. Those are obviously combined totals across their different accounts individually. And in that brokerage account right here, you can see they've got $160,000 as their cost basis in that account. That's going to be important as we go through this here in just a moment. But about 20% of the total, 40,000 out of 200, is actually long-term capital gains. So they have qualified dividends for that portion, and they're going to have some capital gains as well. So what we've got here is they need $100,000 of income to sustain their life, do what they want to do, enjoy retirement, and just meet their normal needs. So $100,000 is what they need. They have no debt. They have 2 grown kids and 1 grandchild at this point. So that's an overview of their situation. Here's what we're going to do. We're going to go through 2 different scenarios. One where we have just IRA distributions and Social Security income, and then another where we have IRA, Roth IRA, and brokerage account in combination with their Social Security income. And I want to point out a couple different important things on that as we go. So let's go ahead and start on the first scenario here. And I'm going to go through how to calculate Social Security taxes. And if you're somebody who doesn't know how that works or even what that even looks like, I encourage you to watch this video first, but then go back down in the description. There's going to be a link to another video where I share how Social Security taxation works and all the different rules and things to do to know there whenever you are trying to figure out what your tax should be on your Social Security benefits. So I'm going to run through this a little bit faster, but go check out that video if you want to look at that in more depth. So let's see what their tax bill is going to be on this $100,000 whenever they have $50,000 coming from Social Security and then $50,000 more coming out of their IRA. So the first thing we have to do is we need to find what's called the provisional income. And again, referring to that video there, we know that half of their Social Security, that's how much we take to find this provisional income, and then we add in their other incomes. In this scenario, it's going to be just that $50,000 from their IRA. And what that leaves us with is going to be $75,000. Okay, so $75,000 is their what we call provisional income, or the IRS might refer to it as the combined income. Now what we have to do is take this $75,000 and run it through the provisional income tax brackets. And you can see them on screen here. For married filing jointly, the first $32,000 of the provisional income, none of that is subject to taxation. The next $12,000, 50% of that is subject to taxation. And then anything from $44,000 or above, that portion, 85% of that amount is subject to taxation. And just so you know here, at most 85% of anyone's Social Security benefits are ever subject to taxation, not all of your benefits. So it could be anywhere from none of your benefits are being taxable, which we might see here in just a moment, and then all the way up to 85% of your benefits could be taxable. So let's take the $75,000 and let's run it through the combined income or provisional income tax bracket. So $75,000 minus 32. We know that, remember, 0% of that 32,000 is actually subject to taxation there. So we have, let's see, 43 left over. We take out the next 12, which again, 50% of that amount. And you can always refer to the PDF there. And if you want a copy of this PDF, shoot me an email with all these important numbers here for 2025. Shoot me an email. My email should be listed down in the description below. I'll happily send that over to you. You can use that however you need to. So let's continue on here. And we know that we've got, what is that, $31,000 left over. That is going to be 85% of that $31,000 is subject to taxation. So if we look at this and we do some quick math here, we know that half of 12 is $6,000. Okay. And we know that 0.85 times 31,000 equals 26,350. Okay, so we add those two together and we know that we get 32,350. So what this is telling us right here, that number, that 32,350, that is how much of our Social Security amount that we're getting. We're not paying tax on all $50,000. We're only paying tax on $32,350. So the first thing to know here in this video is that your Social Security is tax advantageous, meaning Less of it is going to be taxable than any other type of income from a normal income standpoint, not including capital gains. But just know that this is an advantage to you to have Social Security income because, again, at most 85% of your benefit could be taxable. But if we do some quick math here, we can say divide that by 50,000. We can see in this scenario that only 65% of their Social Security is going to be subject to taxation, not 85 or not all of it. So just know that that's what that calculation is trying to figure out by doing the provisional income tax bracket, is to figure out how much of your benefits are taxable. In this case, we know that. And now that we know how much is subject to taxation, we take that amount and we add it back to their other income to find out what their true taxable income is and how much tax they're going to pay. So again, $32,350. That's how much of their Social Security is taxable. We also know that they're taking $50,000 out of their IRA, so that's going to be completely taxable. We add those together, that equals $82,350. Okay, so that's our new, what we call our AGI. So it's not $100,000. That is not our AGI. $82,350 is our AGI. Now, what we do next is we take this and we run it through the normal income tax brackets. In this scenario, I'm going to use the standard deduction, and here in 2025, that is $30,000. They're under age 65, so they did not get the extra amount just yet. But what we'll do is we will subtract out $30,000. That leaves us with $52,350. Okay, so $52,350, that's our new taxable income. Okay, so what we do then, we take this amount, we run it through the tax brackets. We know that the first in 2025, the first 23,000, I think it's 850. Yep, 850. We know that 52,350 minus 23,850, that equals 28,500 left over. And so this right here is the first tax bracket, the 10% bracket. So we would take 10% of that. That's our new tax to be paid on that amount of money. We know that this is going to fall into the 12% bracket because we're not going over the 12% bracket based on that amount of money. So that means that equals 23,850, and this will equal 3,420. So we add these together, equals 5,805. That is their total tax to be paid on $100,000 of income between those two sources. So just under a 6% tax rate, effective tax rate on all $100,000. That's really low. So they're going to pay just under $6,000 in taxes on that 100. So that's one way that they could generate income to get their $100,000 based on their portfolio and based on the assets they have. Now let's look into the second scenario in terms of how they could pull income out and create that $100,000. So here's the second scenario that we need to run through. We're going to keep the Social Security amount the same, so $50,000 is what they are getting. Now, we're not going to take $50,000 out of the IRA. We're going to split that out over their IRA, their brokerage account, and their Roth IRA, and here's the increments in which they're going to do that. So we're going to take $20,000 out of the IRA, we're going to take $15,000 out of the Roth, and we're going to take $15,000 out of the brokerage account. Now, for that brokerage account, I highlighted here that $3,000 of that $15,000 is actually going to be a long-term capital gain. So that could be taxed differently. We're going to show you in a minute how that might not be taxed and why, but we have to factor that into our equation here as we think about this. So we're going to run through the same scenario. This one's a little bit more complicated because there's other variables added in, but let's run through this and see what happens here. So we're going to take, the first thing we got to do is find the provisional income. So we got to do that part first. So let's go ahead and do that. So we know that $25,000, that comes from our Social Security, so 1/2 of this amount, okay? We add in the other $20,000 from our IRA right here. And now we also have to add in this $3,000 from our long-term capital gains. That's technically going to be included in our adjusted gross income number, so we would add that in here as well. And so what that gives us is 45, so $48,000 is our provisional income at this point. Now, I'm going to see if that's the same or less than it was before. It was actually 75,000 before. So just because we are taking from different sources instead of all from the IRA, your provisional income gets cut in about half. Well, actually, a little more than half is still left over, but a good chunk is taken off. So $48,000 is our provisional income. We're going to run it through those same married filing jointly provisional income tax brackets. And we know, if I do this correctly, we know that 48,000, we subtract out the first 32,000, okay? And that leaves us with 16. We subtract out the next 12. And that leaves us with $4,000. So again, that first $32,000, when we're looking at these brackets, we know that none of that is taxable. We know that half of this amount is taxable. We know that 85% of that amount is taxable. So again, that equals $6,000 here. And if we do some quick math on the $4,000, we can just see really quickly That is $3,400. We add those two together, and that equals $9,400. Okay, so that is our new amount of Social Security in this equation that is subject to taxation. So before it was $32,000. We see that there. So this amount here, that is what our taxable amount of Social Security benefits was the first go around. Again, $50,000 in both scenarios of Social Security benefits, but because of how our other income is staggered and stacked together, $32,000 was the provisional or the total amount of Social Security taxed in the first scenario. In this one, it's going to only be $9,400. So a lot less of their benefits are subject to taxation because of how their income is constructed, meaning they're going to have some money from Roth IRA, which is tax-free. So now that we know what their total amount of Social Security that's subject to taxation, we take this and we add it back to their other income and see what their total tax on their $100,000 might end up being. Let's say we have $9,400. That's our Social Security. We're also going to add in their $20,000 from their IRA. And we don't have to add in this $15,000 from Roth because that's going to be tax-free money. They've had the account open for at least 5 years and they are above age 59 and a half. So that is completely tax-free, will not be added in. And we know that the majority of this $15,000 from their brokerage account is not subject to taxation. That's just the return of principal that they initially put into the account. But we have to add in this $3,000 right here. That would be capital gains. So this is a little bit different. I'm going to walk through this as we go, but we're going to add this in, and that's long-term capital gain. So their total adjusted gross income in this scenario is going to be, what is that? 23 plus 9 equals 32,400. So that $32,400 is their new AGI in this scenario, but that $3,000 we have here, that's a long-term capital gain, is technically included and stacked on top to make up their true AGI, but it's not going to be taxed the same. So it's going to be taxed as a long-term capital gain, and I'm about to walk through how that works in just a moment and show you that it's going to be advantageous for them. But we're going to back that number out whenever we start calculating taxes on this part. Okay, so we're going to back that out, and that gives us $29,400. So that's our AGI that is applied to our normal income tax bracket. So if we know that, and I'm going to come back here to this $3,000 in just a second and show you how that would be taxed. So $29,400, that is going to be less than their standard deduction of $30,000, right? Here in 2025, that's what they're entitled to. So we know that none of that $29,400, none of that is subject to taxation. There's no tax to be paid on that because they're going to have a standard deduction and it's not going to go into the first 10% bracket there. It's not even going to get there because there's not enough money. So no taxes on their IRA distribution, no taxes on their Social Security income, no taxes on their Roth IRAs. Now that leaves one thing. It leaves that $3,000 here for their long-term capital gains. And if we look here at the long-term capital gain brackets in 2025, we can see that the first $96,000 and change is actually at a 0% long-term capital gain tax bracket, which means that $3,000 is going to pay a 0% long-term capital gain tax, which means it is not taxable or it's tax-free because, again, they're $29,000 or in this case, they're $32,400. We can see that here. That's the number there that would kind of be used to figure out if they're up to that $96,000. They're obviously well below that $96,000. So that's the number used, and that $3,000, that's going to be completely tax-free as well, which means after all of that, they're going to have no taxes on any of their income. And that has to do with the fact, again, of how their income is being sourced, where that money's coming from. This is not paying tax. This is not paying tax based on those long-term capital gain rates I just showed you. This is not paying tax, and this is not paying tax because of how Social Security taxation works, how it's calculated, how the provisional income actually works out to become how much of your benefits are taxable. So the lesson here is this. Whenever you get to retirement, having multiple sources of income to pull from, so you can pull from a Roth, you can pull from a brokerage account, you can pull from an IRA and also have Social Security. If you have different sources of income, you create tax flexibility for yourself. And this is what's called tax diversification so that you have that opportunity in your retirement years. And if you're not there yet and you're trying to figure out how to lower your taxes in retirement while you're still working, this is a way to do that. Start saving to a brokerage account. Start making sure you have money in a Roth and start building up capital there so that whenever you do get here, you have flexibility on where you want to pull money from. Now, this doesn't mean that everyone gets this opportunity or everyone should even do the strategy as I've shown it here because many of you have large IRA balances, $1 million, $2, $3, $4 million IRA balances, and that money's all tax deferred. So it might be more beneficial for you to pay more tax now by taking money and living off of those IRAs at a higher capacity instead of pushing that into the future future and letting those IRAs grow and building up a larger R&D bill for yourself and larger taxes in the future once you're 73 or 75. So this is not a one-size-fits-all scenario. This is not a one-size-fits-all thing, but I did want to show you that this is possible, that you can have $100,000 of income in retirement without paying any taxes. So let me know down in the comments if this was a helpful video to watch and kind of learn more about how income in retirement might be taxed and some of the ways that you can lower your overall tax bill. Also, go watch this video right here to learn more about how capital gains taxes work in retirement.